Welcome to the Market Insight Show, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. I would say joining me this month is Chris, but I think I'm joining him. I was out last month, so am I allowed to come back?
Yeah, it's great. It's great to have you back.
I think you had more views than we did whenever I was here, so I was wondering if I should be coming in. But why don't we jump into it? We have a lot to cover today, so why don't you just let us know what's going on for the last 5 years in the market?
I pulled the broadest chart we could. So we're taking a step back. What does the market look like over 5 years? Drawn on it are channels, so that's the thick blue lines of common prices. Breaking outs below, where it would be an extreme downside breakout, and above, obviously, extreme breakout to the upside. We're right towards the top of the channel, so normal, a little bit elevated. But the other thing to look at is I have a lagging 200-day moving average on it. So that's that blue line that lags. It moves up and down a little bit slower. So that's the prices of the market from the last 200 trading days. So about 10 months. And a lot of technicians will use that as an indicator of, are we in a long-term uptrend or downtrend? So the long-term trend is still down. You see that it's still coming down. But we have a lot of positive technical indicators that we'll talk about here in the short term that are pointing to some more upside.
You know, it's interesting because if you were to go back in 2019 and look at this trend from there, and you could see your account values, and you were not aware of that big spike, you'd feel like your market, your accounts are doing well and they're up and they're right on your trajectory, and we're a little elevated whenever we look at that channel. So it's all just the point that you're measuring from that really matters. But to your point, we're on a solid trend here.
And one of the things that plays a big role in this is interest rates. So this is a 10-year treasury. We talk about it all the time. It's your basic discount factor that you're going to use when you're discounting cash flows back to today. We call it the risk-free rate. Started the year at 3.88, and there was a pretty big decline through January, down to 3.4. So that's actually a rally in bond prices, and that's why I used red to show the bottom and not green. And then prices in bonds sold off again, and that's rates moving back up to 3.7%. So basically, on the year, no change in rates, but we did have this bullish move in stocks throughout January, which part of it is when rates go down, you are going to see equity values go up, all else held equal, just with the simple discounting. So that was a bullish move, and also stocks have held pretty steady since February as rates have come back. So pretty good sign to see stocks staying flat while rates were coming back up.
We're starting to see some optimism there. At least the market must be, whenever you look at the different variables, it's starting to give earnings growth, at least in the distance.
And that was a market-derived rate, somewhat market-derived rate. The Fed does get involved in purchase and sales of some long-term rates. But absolutely on the short end, the Fed fund rate is contained by the Fed. They set this rate. So we've seen big moves in here as well. And in January, there was this narrative throughout that the Fed was going to cut rates. And we can actually see up through February, that's the purple line here, that it starts to come down towards the end of the year. The market was saying on February 1st that the Fed is going to actually cut rates a couple times by the end of the year. And that was widely held throughout January. That was supported some of the rally, it seemed. In the last couple days, that line's moving up. The futures are taking that price out, and they're saying rates are probably going to stay about where they are. There's probably not much of a cut coming. They're going to raise rates maybe once or twice coming forward. But again, the good sign here was the Fed pivot is no longer priced in markets, and stocks did not sell off with this news as there was a repricing.
So then what about this soft landing that we have been hearing about? Because I think that was why the market was starting to show a decrease in rates, as they expected moving into a recession or at least a soft landing. But
yeah, early on in the year, I have that big area circled called soft landing, no landing. We've been saying that soft landing it's possible. A hard landing would be a strong recession. That's probably not going to happen, and we thought it would be somewhere in between. Well, now the new information that's been coming out, this new narrative that people have been saying throughout January was no landing, that the economy is going to be just fine. And we actually heard it on our show when you were out last month. The guys from Wisdom Tree, they were some of the early on in that narrative, saying that they think their base case is no landing. And it seems that narrative has helped spark a technical rally. If you're willing to give a reason why you think there's a fundamental case for that, it's pretty difficult.
Well, the technicals are saying something different, right? The fundamentals, you can continue to say, hey, this is the most telegraphed recession, and there's a credible case, but at least the market, whenever we look at prices on what they're trading, they're no longer putting stock in that narrative as the most likely outcome. They're saying, well, maybe it's not as bad as we once feared.
Right.
Then
we closed out December negative, right? So we hear a lot about technical rallies, the Santa Claus rally. So the next one is the January effect, which is just that markets do really well in January, especially if they did poorly in December. Reasons for tax loss harvesting, a lot of reasons, and this has not held the last decade. It did hold for a very long time, decades ago, but we see this year, we can look at actually the averages. So the year-end return when you have a positive January, which we did have, on average, and the median is between 16 and 17%. And conditioned that you have a positive January, you have a positive year almost 90% of the time, 88.37, with only 11% of the negative year following a positive January. The market does trend up, right? We know that, and positive years are about 70% of the time anyway, but closer to 90 after you have a strong January.
So if we were just statisticians and we accepted that this is a viable sample and a representative sample, we'd say, well, there's less than a 12% chance that we have a down market this year. Now, that would be a false assumption. Statistics would say, hey, you don't have a large enough sample size here. But at least the history is saying, hey, this is, and then also look at the negative Januaries. It's a coin flip. Half the time it's still up, half the time it's not. So that's one of the reasons that you don't necessarily want to trade that January effect, which we've talked about before. If you have a 50% success ratio and you got to do it twice, which is timing in and out, then your combined accuracy would be about 25%. So that's why you don't want to start really trading a lot on these January effects. But if you're going to, use the positive January as your trading signal, because then you're 64% more likely with the two decisions that you would have. So I think this is another one of those technical indicators that the market is following and saying, well, hey, there's another story here besides just the fundamental story.
And I did just want to pull a quote from a prominent technician, just to show how they, and he's joking, but I just wanted to show how, he probably not, but I want to show how they view the world. And he said, life is harder when you ignore price in favor of such arbitrary things like the economy or corporate earnings. What kind of serial killer puts that sort of gossip ahead of the tape? Right. They're only looking at price.
And there's an argument to be made there. Well, why do people follow technicals? Because the most informative component is the price that people are paying for those future earnings. It's not that people are uninformed or don't know it. The idea is that technicals are telling a story because based on the entire market's action and what their assumptions are whenever they're building the fundamental case. And if you're looking at this, you're saying, well, overall the market is more optimistic than it is pessimistic. We can see that in the prices. That's why people would pay higher prices for these fundamental assumptions. They disagree with the pessimism, so they're a little bit more optimistic. So,
and of course, to summarize also technical analysis, is you're looking at past prices, trying to predict future returns, and you're weighting them differently depending on your model. We do it too, right? We have a Sigma strategy. Yeah, and right now it's saying growth has just taken off. Value still looks good, very strong. Small cap value is looking very strong. Don't need emerging markets, according to technicals right now, and international developed. Pretty broad. There are a lot of areas, sectors that are performing, often called breadth when you have a lot of stocks performing. Another strong technical signal that things are working in the market. On top of that, here's a chart called a golden cross. This is the year-to-date S&P 500 is the black line, and then circled in gold. I made the mistake in the past of not using gold for golden crosses. Did not make that mistake this time. That's when you have the 50-day moving average, so prices only over the last couple months, starting to outperform that 200-day that they talked about. It's a strong technical move saying, hey, there could be a trend change here. Right. And when we look historically, especially after, and we've actually used the same slide to prepare for this in November, December, before the golden cross had happened. We said, well, when the market's down over 20% for bear markets and we get a golden cross, only one other time have you gone back and tested that previous low and made new lows. So that would be the October low. The market was in the 3,500 range.
Right. So once again, if this was a statistically sizable sample, which it's not, you would say, well, man, you really have to invest. So another technical indicator that's changing the view of the market, or the market's changing its view and it's showing up as technical indicators, is probably the way that a technician would say it. These aren't good odds if you want to fight this. Right? You got one out of the dozen where we went back and retested the low. And another thing is, this bear market fear is getting very long in the tooth. Right? Most of the market spends time in that uptrend, and we've been in the downtrend for quite some time. And we do know that what cures bear markets is simply time. So as we've gone further and further and the calamity has not happened, the less likely it is to happen, and we start getting the market forces taken and all this into consideration and start to build for growth, because that's what markets do.
So we talked about the beginning part of that, and the soft landing, no landing, and well, what's happened in February? February kicked it off right away, had an FOMC meeting where the Fed had a chance to say financial conditions are too loose, we need to slam down the market like they've done in the past. Kind of tried to do that in his prepared remarks. In the Q&A, he really talked markets up. It's something he frequently does in Q&As. The way he answers questions makes it sound like he's a little bit of a dove and he's not going to, he does not want to see a strong decline in the economy. So that was supportive. What was not super supportive, and we'll talk about here, is earnings. They were just okay from a top-line view. That had the chance to bring down the market. It did not. And we also had CPI the other day, yesterday, and it was just an okay number. Market was expecting it, and it did not bring down the market again. So some of these short-term things that you thought could maybe stop this bull move did not happen.
And I think one of the important things to do, especially whenever you're looking at investments and trying to make decisions on trades, etc., is never pay attention to the headlines. Always pay attention to the market's response to the headlines. So if you have a bullish headline and the market sells off, well, that's a pretty big bearish indicator. But at the other side, if you have something that's bearish but the market continues to move up, that's a pretty good bullish. So it's far more important on how the market is responding than it is to the news. And yes, you can make the argument that Powell is doing some damage control after his announcements, a little schizophrenia on how you deal with FOMC. Each chair has their own strategy. But there are other things here besides just Powell's remark, as you were saying, the earnings and the CPI report. And the market's shrugging them off. Bad news, but the market continues to move up. That's an important thing to understand and consider. And then another component that is that the market is a leading indicator to the economy. And that's important because we will start to see the market to respond to the future economy before the future economy goes. So here it shows us that financial cycle has bottomed well before the business cycle has bottomed. So we may be in that case where we're starting to see the headlines that are rough because the business cycle is still there, but we're seeing the market indicate, hey, we're past, we've at least been able to digest enough information to know that this is starting to end, and we can start to see price appreciation in the market.
Because on average, the market is going to bottom somewhere between 4 to 6 months before the economy bottoms. And if you would look at the market behavior now, they're saying maybe there's only a little bit more to go for earnings declines, and then the future, like you said,
and that would still be consistent with the call of even a soft or hard landing, because let's say that recession shows up June, July. Well, we're 4 to 6 months from that, and this makes sense. We're right in that time.
Where we are so far, we've had 80% of companies reported. So most of the S&P, like I said, there was a chance to reduce some of this bull market. Most of it's already happened. There's still some big companies that haven't reported, like NVIDIA and Berkshire Hathaway. They're big weightings, but unlikely to change the narrative that the market was expecting these earnings to come in. The beat rate was 69%, earnings above expectations. That's below the 5-year average of 77%. And when we look at the actual year over year comparing to the fourth quarter of the year before, there's a decline in almost 5% on these earnings. Energy's been extremely strong, so if you move that from your sample, the rest of the market in earnings is down 9%. So pretty big decline in earnings, and like I said, market did not did not flinch with these numbers.
Which means the market's pricing those in. They already expected it. And there's no new information that's making it more pessimistic than it already was.
And that's what the chart showed, is that historically when you have bad earnings, or a surprise to the downside, there's a 2% down, 2.2 sell-off. Well, this quarter it was only 0.4.
So we're not getting that. So then let's talk about inflation. One of the things that we've talked about is that inflation's probably going to be higher than it has been over the last couple of decades. There was a lot of things that were really working in the favor of the economy despite a very accommodative central bank policy, really globally. You had demographics, you had supply chains that really could be scaled dramatically, that were global, that you weren't too concerned about where that was procured. Now, we probably don't have that. We're looking to have a more robust supply lane, meaning that it's not all going to be one provider with just-in-time. There's going to be inventory buildup. There's going to be multiple ways of getting supply. There's going to be onshoring. All of those things would say that inflation's probably going to remain elevated. And then we have food and energy prices, very related when we look at the CPI. Those continue to stay elevated. I think I saw a projection of 13% inflation rate in food for the next year. So these things continue to stay relatively high. Could there be new things that come on board that help inflation stay low? Certainly ChatGPT is making the rounds, and the ability to change the way that you do marketing, writing, etc. A lot of that could have an effect, but I think it would be smarter than not to say, well, let's assume a 3, 4, 5% inflation rate instead of a 2 or a 1 inflation rate going forward. And we're starting to see that in the data. Now, if we break this up and look at the quarters, we can see the last few quarters we've had some that are negative. And that's much different than the previous 12, where the average was higher than yesterday's high expectation, which came pretty much right at where market expected it.
Right at what they were expecting.
So
yeah.
this is actually favorable to start seeing some of those negative things. I think inflation does slow, but I don't think we get back down to that 1 to 2% like we were over the last couple of decades. Which then that has an effect on the way that you value stocks, growth versus value. You want to talk a little bit about that?
The chart is the return of the S&P growth divided by value. So when it's moving up, growth is outperforming. When it's moving down, value is outperforming. And there are certain whipsaws in the data where it's year to year, but for the most part, it's a pretty solid trend that lasts over 7 years. From, you can see the 90s where growth outperformed, early 2000s it was all value, and back to last decade where it's been growth. We're right here where it's kind of unknown, a little bit of both. Both are performing pretty well right now. When you actually pull out a lot of the data and you look at factor returns, inflation plays a big part in it.
It does. So if you're thinking about it, with value, you're discounting those earnings, but they're really there in the front of that stock valuation. And because they're value and kind of staples, their earnings don't grow. So when do those do well? When interest rates go up. When do interest rates go up? When inflation goes up. So then if the interest rate is just stable, well, the earnings growth expectation is higher on growth stocks and value stocks, so they'll tend to slightly outperform value. But if you also then have falling interest rates, that'll really help growth stocks because you have interest rates declining and inflation is lower, so those tend to outperform. And growth stocks, at least over this time frame, have tended to outperform value. It's been in these higher inflationary times, whether before 2000, 2008, et cetera, where the value take off. And we're starting to see that in technicals. And if you start to just go through the different scenarios, interest rates continuing to increase, well, we just talked about inflation and the Fed. It doesn't look like anything is expecting interest rates to go up. It's stable. But if we were to go in a recession, that's a decrease. We're starting to see 2 of the 3 scenarios favor the growth stock. So now that our technicals are picking that up, we still hold a value tilt. If we were, so we are beginning to add growth.
Yeah, so the value tilt's in taxable strategies. We're not trying to make too many changes, right. And we're really not trying to make too big of tilts. So we're right here. It's slight. You probably could call it core. The value tilt is about 5%, which is small. So we're looking to try to make a small tilt once we see a little more of the trend of where this is going to go. Again, trying to capture the long-term trend, multiple years for those taxable strategies. But for a qualified strategy, we're entering a little growth run, like you just talked about, and we have tilted towards growth. And for example, the signal strategy, the last two weeks. Yeah.
So we are making changes based on these signals and its technicals. We're not ignoring the fundamentals. We spent a lot of time talking about technicals today and the optimism that's there. There's still that pessimistic case for fundamentals, so we're not going all in and saying be very aggressive here. We're taking more of a muted approach and trying to stay close to our benchmark because there isn't a clear trend that has yet to develop. But we are making those changes because if you just stuck with the fundamentals and you ignore the technicals, we're going to fall behind our benchmark if all of these technicals are correct. But once again, we're not ignoring the fundamental case either. We're just allowing our rules to help guide us within the portfolio. You got any other things that you wanted to add today?
No, got it all.
Well, we appreciate you tuning in this month, and our backlights on our sign went out. So if we get enough likes, I think I can go to Dan and get a budget to get those lights back on. So while you're there, make sure you hit that like button. If you haven't subscribed yet, hit that subscribe button, and feel free to share so other people can like it and we get these lights back on. We appreciate it, and have a good time, and we will see you next month.